So the paper that I would like to talk about is about the relationship between finance and industrial pollution. It's joint work with Alex Popov at the ECB. And basically what we try to find out is whether there's a relationship between the size and the structure of the financial system of a country on the one hand, and how polluting industries in that country are on the other hand. So the reason for looking into this is that we know that if we want to combat climate change, we need to keep the global rise in temperatures, somewhere between 1.5 and 2 degrees. And to do that, something called the green transition will need to happen. So we will need to make sure that the industrial production structure of countries worldwide, not just in the West, but also in emerging markets, really needs to change fundamentally. Now, that change will basically only happen if there's enough financing available. And as part of the Paris Agreement, there's a lot of attention for specific green finance vehicles. I think green bonds may be the most important example of that. But we also know that these special green finance initiatives will not be enough to basically generate all the funding that we need for this green transition. So the regular financial system will need to play a big part as well. So we thought it would be interesting to see how regular stock markets, regular banks are actually impacting the amount of pollution that a country emits. So what we did in the paper, what we do in the paper is we create a relatively large data set with industry level data for a large number of countries and a large number of years. And we see what happens when the structure of a financial system and the size of the financial system changes over time. And the way we look at the impact on pollution is that we compare basically the gap within a country between the most polluting industries and the cleanest industries. So we see that across the world, some industries tend to be particularly polluting and some industries tend to be particularly clean. And that gap between those two types of industries actually is smaller in some countries than in others. And the idea that we had is that that gap, or the size of that gap, may actually be due to different financing structures. And that's exactly what we find. Now, why is this the case? What we see is that the size of the financial system doesn't seem to be that important. What seems to be much more important is the structure of the financial system. In particular, in countries that move to a more equity-based financial system, we see a much more rapid decline in that gap between very polluting industries and less polluting industries. And so that's for two reasons. There are two mechanisms that seem to be at play. On the one hand, we see that the most polluting industries actually start to become smaller relative to cleaner ones. So clean industries are expanding faster, dirty industries are shrinking as a result of the expansion of stock markets. So there seems to be some punishment and some reward in terms of how polluting industries are. And then within industries, so this previous mechanism was really about a cross-industry reallocation. What we see within industries is that when there's more stock market funding available, there's also a decline in pollution per unit of output. So there seems to be more innovation, green innovation going on. And actually what we try to do in the paper is to pinpoint that exactly. And we see that when we look at patenting data, that in economies where there is more stock market financing available, more equity financing available, there's a relative increase in polluting industries in terms of green patenting. So we really see that these industries are making an effort to clean themselves up, and they're being pushed by the stock markets to do that. Now, you can think about these are just patterns that we observe in the data, and it's interesting to think about potential policy implications that stem from that. And without pushing that too much, I think there are two things that may make sense. One is we know that in a lot of countries, tax systems are skewed towards debt finance. So there is a sort of a political push towards debt finance vis-a-vis equity. And so making the tax system more neutral, getting away from that bias, may have sort of a positive, a green collateral benefit as well. And so I think that's something that policymakers can take into account. The other thing, and that's more important perhaps for a lot of emerging markets, is that we know that it's very difficult for countries, or for some countries, to actually develop these equity markets. So that may be important for a lot of other reasons. We know that stock markets and equity markets are good for innovation more generally. We argue that there is a green benefit of this as well. So that makes it even more important that countries try to let those stock markets emerge naturally. And one way of doing that is by making sure that minority investors in those markets are actually well protected from insiders or from majority shareholders. So again, that's a quite general policy recommendation that may be good for other reasons, but there may be green benefits, if you will, from that as well.